Hello, welcome again to our annual economic and capital markets briefing. Thank you for attending today. So as we've done in the past, we start off with the debt markets, reviewing our issuances and issuers against a backdrop of a very eventful rate environment in 2022. We take a look at the equity markets as well, which you will agree has been a volatile 12 months. But first, one of the biggest stories last year was, of course, runaway inflation and attempts to tame it by the central bank. You will recall in 2021, the BSP had kept its policy rates flat, keeping monetary policy supportive amid headwinds we've encountered during the pandemic. In 2022, however, we saw a rapid and drastic shift in BSP stance as inflation heated up globally due to a few factors, one of which was continued supply chain issues. Second was pent-up demand as we are coming out of the pandemic. And third, rising oil and food prices brought about by the Russian invasion of Ukraine. Furthermore, the Federal Reserve's hawkish pivot pressured central banks around the world, including the BSP, to move in lockstep. So over the course of the year, as you've heard in the poll, the Monetary Board hiked policy rates 7 times, or a total of 350 basis points. Due to the rapidly increasing inflation, the benchmark yields have accordingly risen as investors demanded higher returns. So you will see from this chart, BVAL started to adjust upwards in the fourth quarter of 2021, with a further uptick noticeably in February 2022. So last year, we saw a massive upward shift in the yield curve by an average of approximately 274 basis points. Towards the end of the year, there was a flattening of the curve as the rapid BSP rate hikes pressured yields on the shorter end of the curve. The spread between the 10-year and the 2-year narrowed by half, from 214 in December 21 to 100 basis points in December 22. So if indeed inflation peaks in the first quarter, then we expect rates to peak in the second quarter, with yield curves rising by as much as 70 to 100 basis points. Thereafter, we expect the yield curve to retrace its path downwards to end the year at or below the level of December 2022, possibly lower by 12.5 to 50 basis points. We also see a slight steepening of the curve, with the 10 and the 2-year spread increasing back up to around 150 basis points. Of course, all of this would depend on the speed and magnitude of the rate movement would depend on how soon inflation is tamed and whether there's additional monetary easing, for example, through a reserve requirement cut for banks. In 2022, issuances continued to grow, with total debt issued at over 1.3 trillion pesos. Corporate bonds again posted a record high at 327 billion, or over 100% jump from a year ago. This came side by side with 2 jumbo RTB issuances, contributing almost 900 billion to the government coffers. For this year, however, we expect a slowdown of volumes as elevated rates continue their upward momentum, discouraging issuers from coming to market, with issuers deciding to stay on the sidelines while finding a more appropriate time to issue. As in previous years, frequent issuers such as Aboitiz, Ayala, SM, and San Miguel dominated the market. The San Miguel Group led total bond issuances by a wide margin, raising 130 billion pesos, accounting for 40% of the market. This was followed by Ayala Group at 21%, SM at 13%, and Aboitiz at 9%. We also saw 2 ASEAN green bond issuances this year from AC Energy and Arthaland, as well as 2 maiden bond issues from Converge and Cebu Landmasters. So moving on to the equity markets, this chart clearly shows the volatile ride we've been through these past 12 months. So at the beginning of the year, we started off at around 7,000 or so. The PSE index showed much promise, rising to the 7,500 level. As with the rest of the world, we were very hopeful for a strong reopening as we are coming out of the Omicron wave. Sadly, those dreams were dashed by Russia's war, which soured investor sentiment and caused political and economic consequences that reverberated globally. So while we enjoyed a bit of a bump in June after the local elections, the stubborn inflation as well as ensuing central bank hawkishness saw heavy foreign selling in subsequent months, driving the PSEI to below 6,000, dropping 18.5% by the end of the third quarter to 5,741. In addition, the US Fed's aggressive hiking of policy rates brought down the peso to an all-time low in October. By December, however, we saw a moderate recovery given the strong GDP growth, and the market's expectation that the rates are about to peak. So we ended the year at 6,566 yesterday. 6,566 by end of December, or 14% higher than 2022 low. Yesterday, we closed at 6,756, which is only 4% down from 12 months ago. Unfortunately, we fared worse compared to our peers, our neighbors in the region. Indonesia posted a modest gain. Correct. While Vietnam, which was the best performing in 2021, plummeted in 2022. With strong corporate earnings expected this year, our 15 times forward PE looks very attractive and enticing. However, in US dollar terms, as we all know, because of the depreciation of local currencies, all the indices in the region, including ourselves, of course, were in the red. After a record 2021, equity issuances dropped by more than half to 84 billion in 2022. With economic and political risks rising in the first half, potential IPOs and equity issuers in the second half, such as Prime Infra Capital and Opson International, decided to defer their IPOs to this year instead. 9 companies debuted in the Philippine Stock Exchange, issuing a total of 21 billion. 4 of these companies were in the SME board, the most seen in a single year. So this is in line with the PSE's push for more SMEs tapping the capital markets. You can see from this graph, SROs dominated the equity market, amounting to 63 billion pesos or 75% of total issuances, which is a complete reversal of the previous year, where we saw 72% of IPOs. The SROs came from 2 established names, Union Bank and Globe Telecom, which issued 40 and 7 billion respectively, accounting for 90% of SROs. Local investor participation in 2022 continued to anchor the market as they have in previous years. However, trading activity was muffled last year due to weaker market performance, with investors staying on the sideline. So the average daily turnover at 7.3 billion, as well as the total for the year of 1.8 trillion, was just back to the level before 2021. So key takeaways for the next several months, next half year. In the local markets, let's go back to the debt. We can expect to see frequent issuers return, mainly through refinancing opportunities. However, as we said, they may exhibit some caution and likely time the market by first bridging maturing obligations. This could continue for the first few months of the year until there is a better picture on the trajectory of both inflation and interest rates, as economists forecast a peak in the first half. So we can see a pickup of issuances in the second half. On the equity markets, the good news is double-digit corporate earnings growth this year is expected to improve market sentiment, inviting investors to take on more risk. So in the near term, while we expect equity investors to remain cautious, hopefully they as well remain agile, rewarding those who react quickly to market news. The market is hungry for a clear positive momentum, which we believe we are starting to see this during this first week of trading. Before we close, happy to share with you the various capital markets deals and advisory transactions we have closed in 2022. And of course, we thank you, our issuers and investors, for your support. Despite one of the more challenging years, we are proud that our efforts have been recognized by you, our clients, as well as our peers in the industry. So that ends our presentation. Thank you and good day.
Thank you very much, Dan. Okay. All right. Okay, there we go.
No question.
All right. No, hold on. No, I thought you were going to say something like that. No. Okay, we do have questions for you. Oh, don't go too far. Don't go too far. Okay. For Mr. Camacho. Okay. In your presentation, you had SMC at about 90% of the total debt issuances. Is that correct?
No, 40.
40. Okay, so nevertheless, a big number compared to the total. With its present woes on power rates, how is this going to affect, or is there an impact on its bond price or credit? Do you care to comment on that?
Sorry, on the power rates.
It has to do with SMC. Yes.
Oh, yeah, I think they were rejected by the ERC.
Yes. So yeah. What's your do you have an outlook with regard to credit or price for that particular issuance?
I'll just echo what we've heard in the market. There was, of course, some concern regarding that development that may have affected the recent bond issues we were seeing, but in the end, they were able to raise the amount they needed at the price they wanted. So I think the market has discounted that.
Okay, all right. Another question for you. Okay. Do you think companies will follow the government's lead and borrow more in US dollars?
Yes. No, I hope not. I hope not. As I mentioned to someone earlier, if you were alive and aware 25 years ago during the Asian crisis, I hope we've all learned our lesson. You have to match your liabilities and your revenues. Now, if you don't have US dollar revenues, do not borrow in US dollars. The local market is very much liquid and has grown, especially during the last 3 years of the pandemic. But even before that, the local market is very liquid. Borrowers with peso needs and peso borrowings can easily tap the bank and the bond market.
Okay. Last, okay, and we'll reserve the others for later. Is it a good time to buy bonds? If so, what tenor?
Yes, it's a good time to buy bonds. Please reach out to your FMIC sales representative. Yes, especially at these elevated levels, and if we're saying that rates are going to peak in the first half and possibly come down in the second, then perfect to, if you have excess funds to invest, to lock in your investment in corporate bonds.
And any particular favored tenor?
From what we've seen from investors, it seems like the 5-year tenor is the sweet spot. But if you have appetite for longer and there's quite of a premium, go 7. If you have needs in the shorter term, go 3.
Okay, all right. Thank you very much, Mr. Camacho.